Hello friends, today we are diving into Avellaneda and Stoikov, 2008, the paper that defined modern market making. Our plan is to rebuild it completely from scratch. We will model the mid price as driftless Brownian motion. We will derive the reservation price, which is the dealer's personal valuation given his inventory. We will implement the exponential fill intensity that links quote distance to execution probability. Then we combine them into the optimal spread formula and run the Monte Carlo experiments. By the end, we will have reproduced figures 1 and 2 and all three results tables from the paper. Everything is synthetic and self-contained, no data downloads. Let us build it. We use our standard scientific Python stack, NumPy, SciPy, Pandas, and Matplotlib with fixed seeds for reproducibility. More importantly, we lock in the exact parameters from section 3.3 of the paper. Initial mid price of 100, terminal time t equals 1, volatility sigma equals 2, time step of 0.005, which gives us 200 steps, risk aversion gamma at 0.1, the order book decay parameter k equals 1.5, and the intensity scale A equals 140. Every number we produce from here on should line up with the published tables. That is our correctness check. Start with the mid price. The paper writes D minus S equals sigma dW. That is, arithmetic Brownian motion, sigma times the increment of a Wiener process with no drift term at all. Why no drift? Because our agent has no opinion about direction. He is a liquidity provider, not a speculator. And why arithmetic rather than geometric? This is subtle, but it keeps the exponential utility integral bounded, which is exactly what buys us a closed form answer. In the discrete simulation, the price steps up or down by sigma times the square root of d minus t with equal probability. That random walk converges to the continuous process. Here are 8 simulated mid-price paths with the plus and minus 2 sigma root t band overlaid in black. Notice how the band widens as the square root of time, the signature of Brownian motion. That widening is the entire source of the dealer's inventory risk. If you are holding stock at time t, your exposure to the terminal price grows with the remaining horizon. The terminal standard deviation across our paths comes out very close to sigma times root t, which is 2. That confirms the discretization is behaving. And here is the key intuition to carry forward. Risk depends on time remaining, not time elapsed. Now, the first real result. Freeze the inventory. The agent just holds Q shares until the terminal time. Under exponential utility, his value function factorizes into 3 pieces. Minus e to the minus gamma x times e to the minus gamma qs times e to the gamma squared q squared sigma squared t minus t over 2. From that, we define indifference prices. The reservation bid is the price at which he is indifferent to buying one more share. The reservation ask, indifferent to selling one. Average them and everything collapses to something beautiful. The reservation price R equals S minus Q gamma sigma squared times T minus T. Long inventory drags your valuation below the mid. Short pushes it above. These two panels show the reservation price in action. On the left, the skew against inventory at several points in time. It is perfectly linear in Q. Every extra share you hold shifts your valuation down by gamma sigma square times the time remaining. On the right, the same skew as a function of time for fixed inventory levels. Watch what happens as t approaches 1. All the lines converge to 0. That is the model telling you something sensible. Near the horizon, inventory is no longer risky because the price cannot move much before you mark out. At t equals 0, holding 3 shares skews you a full $1.2 below the mid. At 0.95, just 6 cents. Where does the field intensity come from? This derivation is one of my favorite parts of the paper. Start with two measured facts. Market order sizes follow a power law. The density of Q goes like x to the minus 1 minus alpha. And price impact is logarithmic. Delta P is proportional to log Q. Now, your limit order at distance delta gets filled when an incoming market order pushes impact past delta. So, lambda of delta equals capital lambda times the probability that Q exceeds e to the k delta. Integrate the power law tail, and out drops a times e to the minus k delta. The exponential is derived from data, not assumed. The left panel plots intensity on a log scale, so the exponential decay shows up as a straight line. The right panel converts that into a per-step fill probability. And this is the trade-off the dealer faces, made concrete. Quote a quarter of a dollar from the mid, and you expect about 96 fills over the horizon, but you earn almost nothing per trade. Quote $1.50 out, and you capture a fat spread, but only around 15 fills. Somewhere between those extremes lies the optimum. That is exactly what the utility maximization is going to pin down for us. Notice the decay parameter k controls how sharply this trade-off bites. Now we allow trading, and the problem becomes a stochastic control. The value function u is the max over delta A and delta B of expected utility of terminal wealth. It satisfies a Hamilton-Jacobi-Bellman equation, nonlinear, and coupled across inventory levels. The trick is the exponential ansatz. Write u as minus e to the minus gamma x times e to the minus gamma theta. That collapses the wealth dimension entirely. Then expand theta in powers of inventory. Theta 1 turns out to be just s. Theta 2 is minus 1/2 sigma squared gamma times t minus t. Substitute back, and the optimal total spread is gamma sigma squared t minus t plus 2 over gamma times log of 1 plus gamma over k. Inventory shifts the center, never the width. The left panel decomposes the spread into its two economic pieces. The lower band is the liquidity term, 2 over gamma times log of 1 plus gamma over k. It is constant in time, and it depends only on the order book. The upper band is the inventory risk term, gamma sigma square t minus t. It shrinks linearly to 0 at the horizon, so the dealer starts wide and tightens as risk decays. On the right, the same curve for different risk aversions. More cautious dealers quote wider. And here is our first hard validation. The average spreads we compute, 1.35, 1.49, and 3.02, match the paper's tables exactly. Here is the full algorithm, step by step. At each moment, compute the reservation price from your current inventory. Compute the spread from the time remaining. Post your ask half a spread above the reservation price and your bid half a spread below. Then the market decides. You get lifted with probability lambda of delta A times dt, or hit with probability lambda of delta B times dt. Finally, the mid price moves. Now, the comparison. The paper's benchmark is the symmetric strategy. Identical average spread, but always centered on the mid instead of the reservation price. That isolates exactly one variable, the inventory skew. This is our replication of figure 1 from the paper. The dark line is the mid price. Red is our ask, green is our bid. Look closely and you will see the quotes are not symmetric around the mid. They drift above and below as inventory accumulates. When the agent goes short, both quotes lift, making his bid more aggressive so he gets bought back into flat. When he goes long, both quotes drop. And notice the band tightening toward the right edge of the chart. That is the inventory risk term decaying as we approach the terminal time. Near T, the strategy converges to symmetric quoting. These two panels make the feedback loop explicit. On top, the inventory over time. It wanders away from zero, then gets pulled back, again and again. It never runs away. Below it, the quote center skew, R minus S. And it is the exact mirror image of the inventory, scaled by gamma sigma squared times time remaining. That is the control mechanism in one picture. Long inventory pushes the skew negative, which makes your ask more attractive and your bid less attractive. So you sell more than you buy. So inventory comes back. It is a self-correcting loop. No hard position limits required. Time for the main experiment. 1,000 simulated paths for each strategy at gamma equals 0.1. The symmetric benchmark gets handed the inventory strategy's average spread, about 1.49, so neither approach has a width advantage. Same width, different center. That is the cleanest possible comparison. What we expect, based on the paper, is that the symmetric strategy earns slightly more on average because sitting on the mid attracts more fills. But it should carry far more risk because nothing stops inventory from drifting. Let us see whether our implementation reproduces that. There it is, figure 2, reproduced. The blue histogram is the inventory strategy, tall and tight. The orange is symmetric, visibly flatter, with fat tails running out past 140 and losses reaching into negative territory. Same expected profit, wildly different risk. The right panel shows why. Terminal inventory for the symmetric strategy spreads out across plus or minus 20 shares. The inventory strategy clusters hard around 0. And our printed table lines up with the paper's table 1, roughly 65 profit at 6.6 standard deviation against 68 at 12.7. Half the risk for 5% of the edge. The last piece is risk aversion. Gamma is the dial that interpolates between two extremes. send gamma to 0, and the reservation price collapses back onto the mid. The inventory strategy becomes literally identical to the symmetric one, that is the paper's table 2, and it is an important sanity check. Push gamma up to 1, and you get a dealer who will sacrifice real profit to stay flat. White quotes, few fills, minimal inventory. That is table 3. So let us run all 3 settings in a single sweep and check every number against the published values. This is the full replication. This is the complete replication. 3 panels, 3 metrics across all 3 risk aversions. The black dashes on the left panel are the paper's published profit numbers. Our bars land right on them. Look at the middle panel. At gamma equals 0.01, the 2 strategies have almost the same profit volatility, exactly as the paper reports. The near risk-neutral dealer barely skews. But at gamma equals 1, the gap is dramatic. The inventory strategy earns 31 against 44. Yet its inventory dispersion on the right is 3 times tighter. That is the trade being made. Profit for control. One extension the paper does not plot, but which falls straight out of the model. Sweep gamma across 3 orders of magnitude and you trace a genuine risk-return frontier. On the left, each point is 1 risk aversion setting. Low gamma sits up and to the right. More profit, much more variance. High gamma pulls down and to the left. On the right, the ratio of mean to standard deviation. And what is interesting is that it is hump-shaped. There is an interior optimum. Too little risk aversion and your P&L swings wildly. Too much and you quote so wide you barely trade. The best risk-adjusted setting lives in the middle. So, what should you take away? 3 things. First, inventory shifts the center of your quotes, not their width. Under exponential arrival rates, the optimal spread is completely independent of how much stop you hold. Skew is the control variable. Second, every inventory term carries T minus T, so risk decays with the time remaining, and the strategy flattens naturally into the close. Third, the spread splits cleanly into a risk piece you own through gamma and a liquidity piece the market gives you through K. The limitations are real. No adverse selection, no drift, unit order sizes, free requoting. Each became its own literature. Thank you for watching, and I will see you in the next paper breakdown.